And welcome once again, options traders. And I thought this would be a perfect time to talk about one of my favorite topics, what I call the difference in strikes trap. And it's very common in markets like these. When I say markets like these, I'm talking about mid-March of 2020, when the markets are imploding because of the coronavirus scare and the volatility is spiking through the roof. And so a lot of times traders try to capitalize on this by selling calls to collect that high volatility. However, they don't want to sell them uncovered or what we call naked, so they buy another option against it, maybe a longer term one, and then their plan is to continually sell these short-term options against it. And that is a strategy called a diagonal spread. And so this trap can occur anytime you're using diagonal spreads, but again, they're really common when you get into markets like these. So traders often use the diagonal spreads to capitalize on high volatility. That's not a problem. The problem is in the way that they set the trades up. So again, for instance, they might buy a long-term in-the-money call and sell short-term at-the-money or out-of-the-money calls against it. But there's a very big potential trap, and it causes tremendous stress among traders, especially when they find out about it the hard way. And the trap is that they set up the trade so that the net debit is greater than the difference in strikes. They don't really think about it, they don't do it intentionally, but that's just a very common outcome. So for example, let's say that our stock is trading for $100 and the trader says, well, I don't want to buy the stock for $100, so as a proxy, let me buy the 180-day $90 call trading for 20 bucks. So they spend $20 on this call, again thinking that's much better than spending $100 for the stock. And now they can go and capitalize on this high volatility by selling, let's say, a 7-day 105 call for $1. So they're selling this call 5 points out of the money, they collect $1, and again, their goal is that every week they're going to be selling these short-term calls and collecting this money against it. But the problem is, notice how we've set up the trade. We've got $20 going out on the long position, $1 coming back to us on the short position, and that gives us a net debit of $19. And you might say, well, what's the problem with that? The problem is there's only a $15 difference in strikes. Well, you might say, okay, well, what's the big deal with that? Well, when traders put on these diagonal spreads, they often have a big misperception that their risk graph looks like a covered call. And in their mind, they're thinking about this flattened portion right here where we flatten out against the strike. So whatever strike we sell, they're thinking that they're just going to have this flattened portion. No matter how high that stock price goes, they at least can squeeze out a little bit of a profit. But they don't. When you are using a diagonal spread, you've got extrinsic value on that long. You don't have it on the long stock position with a covered call, but you do for the diagonal. So your risk graph doesn't look like this very typical hockey stick shaped graph that we get with a covered call. Instead, it looks like this. So let's say that in our example you have a cost basis of 19, which might be up here on our graph. So yes, if the stock is in this region right here, you'll squeeze out some profit. But unlike the covered call, where if that stock keeps running this way, you're not just leveling off in your profits. Instead, you're heading into losses. Now, how in the world does that happen when this seems like it's a covered call? Well, remember, you don't have 100 deltas on this side. When you bought that in-the-money call, you might only have 70 deltas. So think about it. If you're long 70 deltas over here, and that short option goes in the money at expiration, it now becomes minus 100 deltas to you. So plus 70 over here, minus 100 over here, gives you a net of minus 30. You're actually short 30 shares of stock. And so what happens is that traders go, oh no, I'm heading into losses because my short position is now in the money. Maybe we get a big rebound in the stocks. So they close the short position and sell a new one for a net debit. And that increases the cost basis on the long. Stock goes up some more. They close the short, increases the cost basis on the long, and they just keep jacking up the cost basis on this long position, trying to escape these losses. And then to make matters worse, what usually happens? you've got this super high cost basis on your long, and then the market decides to plummet again. So the whole problem can be avoided if, when you're setting up your trade, that you make sure that your debit, that net debit, is less than the difference in strikes. And that way, if both options end up going deep in the money, there's really no harm done. So what are some solutions? Well, again, remember what your goal is. It is to keep the total cost below the difference in strikes. So you could either reduce the days to expiration on the long call, you could reduce the strike of the long call, which is going to give you more deltas. You could increase the strike of the short call, or you could also increase the days to expiration on the short call, or any combination of these four. Just make sure that the total cost is below the difference in strikes, and you'll never step into the trap. So I know that can sound confusing, so let's jump over to the E-Trade platform and take a look at an example. So here's the E-Trade platform, and let's use Apple for an example. It's trading for almost 276, down over $9 today, another 3.3%. And so let's say that we wish to do this diagonal spread. There's a number of ways we can do it. I'm just going to choose diagonal from here. Now, one of my favorite techniques, instead of trying to figure out which pairs of expiration dates and strikes that I want by making these selections up here, I just pick any of them. I don't even care which expiration or which strike pairs that I'm looking at. So I'm just going to pick something over here, and my goal is to get this pop-up window to use this as a template. So again, the stock is trading for 276. Let's say that we want to sell the 280 call. Well, okay, I can just come down here, I can find 280, and I choose that. And let's say that I wish to buy maybe a July, and the stock again is 276, maybe I want to buy the 250. So I say, okay, let's try this one. Well, there's a problem. Notice that the mid right now, which is probably where I can get this filled, is about $40, but I've got a $30 difference in strikes. That could potentially cause a lot of problems if this stock rebounds up. Because if I have the right to pay $250 and to sell for $280, that's $30 in my pocket, but I paid $40 for that. So I've kind of handcuffed myself, and I'm going to have a real hard time getting out of this. So what are some of the solutions we talked about? Well, I could either make the long position go further in the money. So if I bring this down to a 230, now I've got a $50 difference in strikes. Mid is at 54. We're getting closer. Of course, we probably don't want to spend this much. What else could I do? I could bring the expiration date in closer. So let's go back to 250 here. So maybe instead of going out to July, maybe I come into May. I'm going to still keep the 250 long strike. So there's a $30 difference in strikes. The mid's 36. Still could potentially put us into a trap. So maybe I can come down to the 240 call. I've got a $40 difference in strikes. It's going to cost me $43.50. Still not good. You can see why it's so easy to step into these traps. What else could we do? I could increase the strike of the short. So instead of selling the 280, maybe we could sell the 285. Now, of course, I'm not going to get as much money for it, which is why most traders don't want to do this. But now I have a $45 difference in strikes and about a $46 debit. So getting better. I could also increase the days to expiration here. Instead of going March 13th, maybe I come out to March 20. That will increase the price that I get and therefore reduce my debit. Now I have a $45 difference in strikes and a cost of a little over 41. This would be a potentially good one to use. Now again, to emphasize, any of those others that I showed you are not necessarily wrong, but they just put you in a potentially very difficult trap to get out of. Because if that stock rebounds, you're going to find it really hard to get yourself out from that short call without spending a lot of money. And if you do, you're just jacking up the cost basis of the long. It's really a trap that you can't escape from. And the worst case is you say, oh, you know what, I'll just exercise my long, let them take the shares from the short position, and you've now locked yourself into a loss. So again, the key is make sure when you're setting up your diagonal spreads that the difference in the strikes is greater than the cost, and you'll have a much better opportunity for profits. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.